The Federal Reserve has spoken. Interest rates are going down. Brace yourselves, America, for a 0.25% reduction in the federal funds rate. This might sound about as exciting as watching paint dry, but trust us, it's kind of a big deal. The Fed doesn't just randomly fiddle with interest rates for kicks. This move is a carefully calculated maneuver in the high-stakes game of managing the U.S. economy. The federal funds rate is the interest rate that banks charge each other for overnight loans. This seemingly obscure rate has a ripple effect throughout the entire economy, influencing everything from mortgages to car loans to credit card interest rates. So, when the Fed decides to cut rates, it's essentially trying to inject a bit of adrenaline into the economy, making it cheaper for businesses and consumers to borrow money and spend. The Fed's decision comes amidst a backdrop of growing economic uncertainty. This rate cut is just the latest twist in this ongoing saga. To understand the significance of the Fed's recent rate cut, we need to zoom out and take a look at the bigger picture. The federal funds rate has been around since the 1950s, and let's just say it's seen some stuff. We're talking wild swings from the double-digit highs of the early 1980s, thanks inflation, to the near-zero lows of the Great Recession. Think of it like a financial roller coaster, with periods of dizzying highs and stomach-churning lows. In the 1970s, for example, the U.S. was grappling with stagflation, a toxic cocktail of high inflation and stagnant economic growth. The Fed's response? Jack up interest rates to try and tame inflation, even though it meant pushing the economy into a recession. Fast forward to the early 2000s, and the dot-com bubble was in full swing. The Fed kept interest rates low, fueling the speculative frenzy that eventually led to the bubble bursting. The Fed's latest move is just another chapter in this ongoing saga. Let's narrow our focus a bit and zoom in on the last 10 years. After the depths of the financial crisis, the Fed kept interest rates at historic lows for an unprecedentedly long time. It was like they were afraid to take their foot off the gas pedal, worried that the economy might stall. In 2015, the Fed finally decided to start raising interest rates again. It was a slow and gradual process, like trying to turn a giant ship around. But then, in 2020, the COVID-19 pandemic hit, throwing the global economy into a tailspin. The Fed slammed on the brakes again, slashing rates back to near zero, and unleashing another round of quantitative easing. Inflation is running hot, fueled by supply chain disruptions, pent-up demand, and the war in Ukraine. The Fed's latest rate cut is a sign that they're not sure which way to jump. Section 4. Projections and Reality. Dissecting the Fed's crystal ball. The Fed fancies itself a bit of an economic oracle, regularly releasing projections for economic growth, inflation, and, you guessed it, interest rates. These projections are about as reliable as a weather forecast in a hurricane. Back in September, the Fed was projecting that interest rates would be at 3.5% by the end of 2025. But guess what? Their latest projections, released just yesterday, paint a different picture. They now expect rates to be at 4% by the end of next year. Inflation has proven to be more persistent than the Fed initially anticipated. Section 5. Reading the market's mind: expectations versus outcomes. The financial markets are a bit like a giant casino, with investors placing bets on everything from stock prices to interest rates to the outcome of sporting events. Leading up to the Fed's latest meeting, the market was practically salivating over the prospect of a rate cut. The CME FedWatch tool, which tracks the probability of Fed rate moves based on futures contracts, put the odds of a 0.25% cut at a whopping 98.6%. So, when the Fed actually announced the rate cut, it was about as surprising as the sun rising in the east. The market's reaction to the rate cut was decidedly muted. Stock prices barely budged, and bond yields actually rose. Section 6. Behind the curtain. The Fed's rationale for the rate cut. The Federal Reserve, despite its penchant for secrecy and its tendency to speak in a language that only economists can understand, does actually have a mandate. The Fed's official mandate is to promote maximum employment and stable prices. So how does cutting interest rates help them achieve this? Well, the theory goes that lower interest rates make it cheaper for businesses to borrow money and invest, which leads to economic growth and job creation. Lower interest rates also tend to boost inflation, which might seem counterintuitive, but remember, the Fed's goal is to keep inflation stable, not necessarily low. In their official statement, the Fed cited concerns about the labor market as the main reason for the rate cut. The unemployment rate ticked up slightly last month from 4.1% to 4.2%. They also noted that inflation remains above their 2% target, but they expect it to moderate in the coming months. The Fed's official rationale for the rate cut is to support the labor market and ensure that inflation returns to its target level. Section 7. Beyond the official script, unraveling the Fed's true motivations. The Federal Reserve is like a poker player with a world-class poker face. They're masters at saying one thing while doing another, and they're always 3 steps ahead of everyone else. Some analysts believe that the Fed's true motivations are a bit more self-serving. They argue that the Fed is more concerned with propping up the stock market and protecting the interests of Wall Street than it is with helping ordinary Americans. Others believe that the Fed is trying to bail out the federal government, which is drowning in debt. Lower interest rates make it cheaper for the government to service its debt, but they also devalue the currency. By constantly bailing out Wall Street and the government, the Fed is creating a system where reckless behavior is rewarded, which only increases the likelihood of future crises.